2020 to 2023 was the party. 2024 to 2025 is the hangover. And what happens next is going to define your financial life for the next decade. The system didn't reset. It snapped. And nobody is warning you about this. For those of you who do not know me, my name is Casey Marks. I'm the founder of Crown Haven, Bull Baron, Pinecone, Annuity Lock. I've spent the last 15 years of my life, over 60,000 hours working directly with families who have been crushed by the fallout of the decisions that they never made before they came and spoke with me initially. I've seen behind the curtain of this financial industry. It's a fundamentally flawed sales industry. I've walked the trading floors. I've sat with the billionaire class. I've talked with the people who pull the levers. I know the incentive structures. I know the mechanics. I've seen the lies, both of omission and just outright lies. And I've seen the consequences of those actions in real time. My mission started when I watched my widowed mother get taken advantage of a system that was never built to serve her after my father passed away when I was 15 years old. I never thought I'd be in the financial services industry, but I am. It's because I care, and it's always been to tell truth. And that's why I've been able to build these companies, because at every corner I've seen issues. And so I built companies to solve those issues. With the finfluencer era, with the ubiquity of information, with technology moving so fast it's making our head spin, I knew I needed to bring this to a larger audience. People need this information. You deserve the truth. You're a human being just like I am. And I'm sick and tired of watching people run in circles because there's so much noise. So this is the signal. For everything I can't say in these videos or don't have time to say in these videos, I'm releasing a book. It's called Inheritance: Blowing the Lid Off of Big Finance. Until then, subscribe, share, follow me at Casey A. Marks, real Casey A. Marks, on X, because I'm going to be exposing everything that the ruling class, the financial industry, hopes you never understand. So let's get going here, and I'm going to give a shout out to Zinn as we do this. Let's talk about the lie they've been feeding you. Here's the big lie. This is like the biggest lie. The economy is strong. The consumer is resilient. Inflation is cooling. The system is stable. None of that is true. None of that matches reality. None of that matches your life. What is true? 2020 to 2023 was the artificial boom created by the largest monetary experiment ever conducted in history. Trillions of dollars printed. QE, rates being cut to zero. 2024 and 2025 is the predictable hangover of that sugar rush of monumental proportions. And 2026 and the next decade and what comes next is going to be incredibly interesting. Your life got harder not because you failed, but because the system was overstimulated and now it's withdrawing from the drug. Let's talk about the party, because it was one hell of a party. Let's be honest about what happened. Not the sanitized academic version, like what happened. The government hit print like it was a video game in cheat code. Trillions in stimulus, QE, liquidity backstops, liquidity windows, corporate rescues. The old boys club got together and made it happen, man, in a big way, in a huge way. They then dropped interest rates down to zero. Money was free. Risk taking was cheap. Speculation was rewarded. As a result of that, what happened? Asset prices went vertical. Stocks doubled. Crypto exploded. Real estate went insane. Companies worth nothing became worth billions. And if you had any of your money in any of those things, you felt awesome. You got high on fake prosperity. Stimulus checks, PPP, extra unemployment benefits, child tax credits, forbearances on your student loans. Man, we were all just like, let's do this. You only live once. It felt like abundance, but it wasn't earned abundance. It wasn't earned. We pulled our consumption way, way forward. The media called it growth. It wasn't growth. It was liquidity on steroids. Imagine Arnold Schwarzenegger in his prime. It's a fraction of what they did with money. We didn't have an economy. We had an adrenaline rush. It was insane to witness. Now the hangover, 2024, 2025, we've seen little cracks. They don't hit during the party. Hangovers don't hit during the party. They hit after the high fades. That's exactly where we stand right now. It is November 19th, 2025. And where are we at? Well, consumer goods, and really anything you need, prices have stayed high permanently. Did the corporations reduce their prices on anything? The answer to that question, Alex, is no. They only continue to raise them. Did your wages keep up with that? Even if you got a raise? No, that's the silent killer. Your income didn't match inflation. Your savings didn't either, by the way. Even though interest rates exploded. Mortgages, they doubled in cost. Like everybody thinks, it's like, okay, I refinanced my house in 2020 and I got a 2.1% interest rate. At 6%, that's 3 times. What is that? How much more are you spending in interest over 30 years? Has anybody done the math on that? I bet a lot of you have. It's nuts. Credit cards are at 28%, 30% in some cases. Cars, worst affordability in history. Business loans are squeezing people. Thankfully, we don't take loans out for any of our businesses. We've always been cash flow positive. We manage our companies well. But holy crap, the people that took out loans. Savings, drained. Stimulus wealth evaporated into thin air. Credit filled the gap. Now credit's maxed out at high interest rates. This is the silent one. The psychological gap widened. People feel poorer. But here's the truth, you are. Maybe not in dollars and decimal points, but in reality, you are. Your costs went up, your income didn't, your currency shrank. That's not a failure, that's math. So here's the most probable future. This is not fear. This is not doomsday profiting. This is just truth. This is not it's not optimism either. It's just probability. This is the part that really matters. Here's the most probable path ahead. This is based on incentive structures and just math, man. And the Pareto distribution. We're playing one big game of Monopoly and people don't realize it. This is not an opinion. This is where the next decade is actually heading. Stealth QE, stealth quantitative easing, is going to become the norm. They're not going to call it quantitative easing because they know people are paying attention now. Markets, pundits, the average American even knows kind of what it is. They're not going to call it that. Instead, you're going to see liquidity facilities pop up, repo interventions, emergency windows, bond rollovers, balance sheet adjustments. You're going to see the yield curve get manipulated in ways that it hasn't been manipulated before. They're going to use different names to create the same effect. Liquidity injections without accountability. The most probable outcome of this is markets are going to float. Families are going to struggle. Number 2, inflation becomes a permanent feature of your lifestyle, not a bug in the system. They're going to tell you it's under control. They're going to say it's near target range, but the reality, prepare for 3 to 6% is your new baseline. It blows me away when folks come into our offices at Crown Haven and they sit down with one of my advisors, or they even sit down with me, because I sit down with clients still, and their advisor has run a Monte Carlo analysis on a portfolio that has a correlation coefficient across the board of like 97%. So all their individual equities, doesn't matter if they're closet indexing or they got mutual funds or whatever. They think they're cool because they've got a whole bunch of individual stocks. Maybe they got some domestic bonds. Doesn't matter. In a black swan event, in a financial crisis scenario, they're going to lose 53%, and the inflation figure they've used is 2%. That's not reality. Oh, and by the way, they're preparing them to underlive their retirement. They're saying only take a 2% withdrawal rate. 3 to 6% is going to be the reality. They used to look at me like I was nuts. Back in 2015, when I would use 3.1% as the inflation figure, they'd say, there's no way. I'd go, do you realize that's the 105-year average? Those same people who have now been my clients for 10 years are super freaking happy, dude, that we use that as the inflation figure in our projections because they're actually able to afford their lifestyle after the fastest rate of inflation in 40 years over the last 3 years. But 3 to 6%, that's your new baseline. Not enough to spark panic. We're not going back to the Carter administration. But this is going to be enough to slowly erode your life every year. If you were to look at inflation over time, the difference between 2% inflation on a portfolio and 4% on a portfolio, man, it goes from like this to like this. With withdrawals, The probable outcome is that whether or not you're in the accumulation phase of your life, you're growing your money, or you're in the retirement phase of your life, this is even more important, you're going to get squeezed. Interest rates are going to stay higher in the process, and they're going to be higher than what you expect them to be. This is ironic because for savers, they're going to go down to the bank and they're going to go, oh, the CD is paying me 5%. Fantastic. You're outpacing inflation by 1%. Maybe. Probably not. But for everybody else, people taking out loans, super expensive. And the Fed doesn't cut because the economy is strong, okay, guys? The Fed cuts because something breaks. Until then, it's higher for longer. They always cut when something breaks. If you were to look at the Fred website, pull up the Federal Reserve reference rate, back to forever, every recession creates a cut, and usually a series of cuts. And they don't do it preemptively. They try to do it preemptively. But I mean, right now, November 19th, 2025, there was a 95% probability of 2 rate cuts by the end of the year, like 3 months ago. Now it's at 49%. They're not going to cut. They might cut. We'll see. But there are already cracks showing in the economy. Until then, higher for longer. Probable outcome, housing is going to remain unaffordable. Debt is going to become heavier. Retirement is going to become harder, significantly harder for people that did not plan for this. Which leads me to my next point. There is going to be a retirement crisis as if we didn't already have one. Social Security was never meant to be the replacement for income, man, and people don't have pensions. So there's a retirement crisis, and there is a dearth of qualified retirement planners out there. There's just nobody, which is why I teach so many people how to do this properly, because there's so few. They're all in accumulation mode, and they're going to tell you the same thing the next time the market drops. Ride it out. It's a paper loss. Buy now. How do I buy more stock when I stop working? That's just a side note. But slow motion retirement crisis is going to unfold. Not a dramatic collapse. It's going to be a quiet erosion. This is going to strain Social Security, which this is an entirely different episode, and I should probably get Heather on here, who's like the nation's expert in Social Security. So I won't go any further into that. But Social Security is going to be strained. Pensions are, as a result, going to be underfunded. For your portfolio, sequence of returns risk, the sequence in which you receive your returns, if you retire right as the market's dropping, or within the first 3 to 4 or 5 years the market drops, you're going to have a really hard time maintaining your portfolio over time. This is all happening as human longevity is increasing. The healthcare system has gotten really, really good at keeping us alive for longer, and private equity gets it. You seen all the assisted living centers popping up? It's an asset class you can invest in, baby. It's a little bit morbid, but there's a reason, because people are living longer, and healthcare costs are going to explode as a result of this, because it's an inelastic good. Most people don't know this yet, but they are going to feel it. You're going to have grandma either eating cat food at 84 or a Walmart greeter with pain. Nobody wants that, man. That's gonna happen. It's not gonna be for the reasons people think. Nobody wants to look at the worst case probable outcomes. It's not fun. Everybody wants to walk around with headphones on like they're in an Enya video. This is happening. Retirees are gonna work at 70. It used to be a choice. When I sit down with families, I go, you want work to be a choice, not an obligation. That's what we're aiming for, a choice, not an obligation. It's gonna be an obligation. And corporate America, dude, they're gonna squeeze out profits from labor. They're gonna continue to do what they do best. AI, it's innovative, but it's not about innovation in this regard. It's about margins. Layoffs through the roof. Productivity through the roof. Wages down. Stocks up. Wider wealth gap. And as this all is unfolding, volatility is going to intensify. I've talked about the boom-bust cycle many times before. Well, that's a permanent feature. It's not a cycle, it's a structure. Tightening is going to be panic. The Fed tightens, panic. The Fed eases, bubble. Repeat, like you're washing your clothes. Probable outcome is that the next decade is not about chasing returns. Do not do that. It's about avoiding financial destruction. It's a properly structured portfolio. The silent killer of this is that the dollar is going to erode slowly. Not collapse, not Venezuela, not doom, just erosion. $1 today will not buy $1 of the same value in 2035. So unprepared families are going to lose purchasing power without even realizing it's happening. I've said it before, I'll say it again. The psychological problem with all of this is people feel poorer. The reality is you are, but not in dollars and decimal points on a page, in reality. And it's because of all of these things. This is the truth most economists are too cowardly to say, and I know this because I know them. Very few people have the guts to tell the truth. I need you to listen closely to this, and I've written this down. Volatility is the new normal. Inflation is going to be persistent. Our debt's unpayable. The growth we've been experiencing is artificial. It's as a result of all of what I just described. The Fed is cornered. They're trapped. The government is addicted to all of this. Why? They want to remain in office. In order to remain in office, they have to do what their constituents want. What do their constituents want? Well, depending upon their constituents, they have things they have to pay for, which means they have to continue this cycle. Asset prices are distorted because of all of this. Meanwhile, geopolitical risk is permanent. We think we're the center of the universe in the United States. Spoiler alert, we're not. There are other countries with different agendas, with different problems. Some the same, some wildly different, that are gonna wanna do their own thing, and we gotta be ready for that. Retirement planning requires more than diversification, okay? Because your diversification isn't gonna save you. The middle class is gonna shrink. I could do an entire video on why the middle class was an anomaly in the first place. Your own optionality is going to become everything to you, and your structure will be your survival. The next decade is not gonna reward the aggressive risk takers, the folks that I just did 300% in quantum computing and then I lost 80%, like literally last month. It's not gonna reward the people following the finfluencers. It's not gonna reward the speculators. It's gonna reward the prepared. So what do you do with all this information? Because this has been a long video. And if you're here, God bless you. I know it's a lot for me to spew out, but I love it and I hope it helps you. So what do? Let's talk about structure, not fear. If you're gonna be retired, you need a protected income floor that's inflation protected. This removes the need for you to guess about your future income. Asset prices over here can be doing whatever they want to be doing. And if you've got income that's protected, you're not going to have to do work when you're in your 70s, want to hang out with your grandkids. When we talk about the assets over here, you need optionality, asymmetric upside potential, limited downside, buffered risk exposure. How do you do that? Well, different types of asset classes, not just stocks and bonds, other asset classes, real assets, commodities, physical commodities, soft commodities. There's so many different ways to go about this. Structured products, etc. Convexity tails, companies that have purchasing power, or pricing power rather. Inelastic companies that people will always need. The paradigm is shifting. And then you need liquidity. Dry powder is how families survive volatility cycles. If you already have your income set up and you got dry powder for emergencies, you're set, dude. This can happen over here and you're fine. Now, even better, you've got this over here, enough of this over here, this dry powder. Guess what you can do? Well, when people are forced into capitulation selling because they took too much risk, or they can't afford their home anymore, God bless them, or whatever, you've got the dry powder to buy the asset on sale, which is what you should be doing. Buy low. The inflation-resistant exposure that I talked about is so important. Pricing power is so much better than any narrative or prediction. And, I'm a proponent of blockchain, but Bitcoin's only pricing power is the liquidity in its marketplace and whether or not monetary policy is loose and the overall scarcity of the asset class combined with the fact that it's supposed to be a sovereign store of wealth. It's not creating value. And so as a result of that, if the Fed tightens, it drops hard, usually. You need to eliminate sequence of returns risk. This is the #1 retirement killer in volatility decades. That's why they called the financial crisis all the way up to 2018 the lost decade. People that had all their money in equities that lost whatever the percentage was that they lost, I can't remember it off the top of my head. I should. It was like 53% in the S&P 500. What's the average return in the marketplace? Well, first, in 2007, it was like 20-something percent. Then it was 53%. So it was a combined lot of percentage losses. But how many, if you take the average return in the S&P 500 for like the past 100 years, it's 10% or something, before fees, expenses, etc., taxation. It's the lost decade, because you lose 50%, you need 100% gain to get back to even, dude. So as a result of this, you need a plan that assumes instability is permanent, because it is. Volatility doesn't have to be your enemy. If you have a weak plan, you will get destroyed by it. But strong plans, anti-fragile plans, use volatility to build generational wealth. And you can build that. So here's your survival checklist. Remember, 2020 to 2023 was a sugar rush. It was liquidity injected at massive levels never seen before. That was not real growth. 2024 to 2025 is the withdrawal phase. The next decade changes everything. Stealth QE is coming. Inflation is permanent. Rates are going to stay higher than comfortable for you. Retirement will get harder. That means volatility will become structural. It means the dollar will erode slowly. That means you will need protected income, you will need optionality with regard to your securities investments, and you will need liquidity both for emergencies and dry powder. Within your optionality bag over here, you're going to need inflation hedges, and you need a plan stronger than the system and everything that is happening around it, because the world ahead is not going to reward either hope nor fear. It's not going to reward you for having all your money in the bank. It's not going to reward you for having all your money in the next AI stock. It's going to reward structure. I hope this was helpful for somebody. If it was, please consider subscribing, liking it, share it with somebody that needs to hear this. Stay tuned for more. I'm not stopping here. And it's very rare that you get somebody, and I'm not tooting my horn here, it's very rare that you get somebody that has seen every single level of the industry and is willing to tell the truth about it. And that's what I'm doing. I was talking to my editor the other day and they said, nobody has ever done a book like this. Well, we're doing it. Get ready. Because the rest of the people online, they're speculating. You're getting little bits and pieces. I'm bringing it all together. Get ready. It's coming. This isn't going to be the narrative. This isn't going to be the headlines. This is not going to be the theater. This is going to be the freaking truth. And the reason I'm doing it is because your family's future depends on it. And I'm so sick and tired of watching people lie by omission. And at the bottom of my funnel, if you were to ask me who I am as a human being and what I believe in, I believe that we are all children of God. I believe we all deserve to be treated with the same level of humanity, grace, dignity as everybody else, regardless of socioeconomic status, race, creed, origin, you name it. Like, who cares? No matter where you came from, you deserve to know you deserve it. Join us, man. Join us. There's going to be people that pay attention. Join.